Have you ever wondered how a regular mortgage really works? Let's start at the beginning. In the United States, most mortgages, about 94% of them, are some form of an amortized 30-year loan. If you look at an amortization schedule for these loans, you'll notice something important. Most of your early payments go to interest, not your home. You're not gaining much equity. In fact, during the first 10 years, about 80% of your payments go to interest. That means only a small part is used to actually own your house. The 30-year mortgage was made to last 30 years. But today, most people refinance every 3 to 5 years and move every 9 to 12 years. We're using a 100-year-old system that doesn't match our modern habits. Here's an example. Suppose you take a mortgage of $650,000 at 5.875%. After 4 years, you will have paid your bank $180,617. Out of that, $145,661 goes to interest. After 4 years of mortgage payments, you'll have paid your bank $180,617, but only own $34,956 of your house, while the bank made $145,661. With a traditional loan, it isn't until year 16 that slightly more of your payment goes to your home than to the bank. You're working uphill for a long time. Now let's talk about your checking and savings accounts. Suppose your household income is $225,000 a year. After deductions, health insurance, and 401k contributions, you deposit about $150,000 annually. The bank doesn't just hold your money. They lend it to other people, invest it, and use it for the operations of their business. When you need money for bills, your car payment, credit cards, and living expenses, they give it to you. Until then, they're making money with your money. You're depositing $150,000 a year that they're using until you need a portion of it to pay your bills. Think about this. Well, you pay almost $145,661 in interest over 4 years. You're also letting the bank use $150,000 a year, which is $600,000 over the same 4 years of your own money. Sometimes they pay a small bit of interest, but they're profiting from your funds. That's good business for the bank, not for you. Now that you see how traditional loans work and how we're all lending our own money to the bank, let me introduce the all-in-one mortgage, or the AIO loan. This loan comes with a checking account. Every dollar you deposit goes to your mortgage principal first. Your interest is calculated daily as simple interest. Then you use the account for your living expenses. In other words, instead of your local or big bank using and profiting from your money, you're depositing with them, you use your money. It goes towards the principal of your mortgage until you need it. Your behavior stays the same. You're just using a bank account connected to your mortgage. So, in the previous example, your 4 years of deposits, that comes to $600,000, all goes towards the principal of your mortgage until you need to pay your bills and living expenses. Until then, you're saving tremendous amounts of interest and reducing the term of your loan, all because you're using your own funds instead of the bank. The average all-in-one loan is paid in full in 8 years, without additional payments. It's powerful because you're paying principal first, and instead of the banks using your money, you're using it. Call me today